And again, touching these circles of conversation that we have, and I was seeing the incredible performance of Treasuries, and I don't really want to challenge where they are. I just think we're creating a price top, if you were, at bottom in yields. One of the factors that I'm more scared about Treasuries as a portfolio diversifier is I don't know if they would diversify a portfolio in the future. Yeah. That'd be my big fear. Yeah. So they've been priced, as I say, central banks have come in and they've created an environment where Treasuries, or all nominal sovereign bond yields, are priced to return almost nothing. Yeah. But you're willing to take that almost nothing return for the diversification factor. And my point is, what if we lose that diversification factor? So you've got something that's priced to make nothing and actually doesn't diversify the risk in your portfolio, right? So I can't prove it, but that's a prejudice and a feeling, I fear. Yep. I fear. So what can I put into my portfolio that does the job of Treasuries, if you will, with bad things happening? And that's where we come into really the analog of the trading that we've pursued successfully since 2014, where we've been paying offshore short-term rates in the Chinese currency, in the CNH. And this year, we've really stepped up the pace in terms of the size and the allocation of our risk to that position. Now we can, because we've got offsetting, but we also want to, because there's some dynamics that go on there. So it's weird. You have this offshore market, onshore. It's not fully fungible. Mm-hmm. You know, there have been moments of stress. We've talked about two moments where it would seem that PBOC had to intervene. Both were in January 16, and was it January this year? January this year. Yeah. And in that environment, the central bank is it's selling dollars, so it's buying CNH. So you're taking cash, China cash, out of the offshore market. So you're draining the swamp, if you will, the liquidity swap gets drained by the PBOC's FX intervention as it comes in, price support, the CNH. You automatically drain. Now that happens at a point where they're very terrified of capital flight. And so to my fungibility factor, what you find is the guys who would sit onshore and say, there's a huge ARB here, I can now come in and lift and guarantee over 5 days, over 7 days or 1 month, a huge return. They can't get beyond the wall. The capital wall goes up. Yep. And so the only factor going on is the PBOC taking CNH out. And so you get this huge uplift. So you're paying those rates, and rates spike higher. And that is a risk-off, long volatility environment. And pretty much one of the biggest fears that anyone has is just the unknown quantity of the dynamic, the dramatic dynamic.
Does that cost you a lot to have on?
Well, you would think. Yeah. You would think it should. And just now, they've had a free pass since they changed their FX intervention policy. The change in they announced, 4 weeks ago. And you're actually having to pay to be long dollar. It's just because it's usually very positive carry, and it's just become negative, which is to say you have to pay to own dollars versus the CNH, which is just nuts. You should be paid to own CNH versus the dollar.